Ever wondered how ETF indexes can simplify your investment journey? Well, let's dive into it. ETF, or exchange-traded fund indexes, are essentially a basket of securities that you can buy or sell through a brokerage firm on a stock exchange. They provide a straightforward way to own a piece of the market without having to buy each individual stock or bond. The beauty of ETF indexes lies in their diversity. Whether you're interested in technology, healthcare, or even international markets, there's an ETF index for that. This wide array means you can easily gain exposure to a broad range of assets, all under one roof. Think of it this way: instead of having to pick and choose every single ingredient for a complex recipe, you're given a well-rounded pre-made mix. It's efficient, diversified, and can be tailored to your taste or investment goals. Understanding ETF indexes is the first step towards building a robust investment portfolio, so let's take that step together. How can one build a well-diversified portfolio using ETFs? Let's dive right into that. Diversification is a key strategy to mitigate investment risk. It's like not putting all your eggs in one basket. When you diversify, you spread your investments across different asset classes, sectors, and regions, reducing the impact if one of them underperforms. Now, how can ETFs be used to achieve this? Exchange-traded funds, or ETFs, are like a ready-made basket of investments. You buy shares in an ETF and you're instantly invested in a wide range of assets that the ETF tracks. Picture this. You could invest in an ETF that tracks the technology sector, another that tracks the health sector, and yet another that follows emerging markets. This way, you're not overly dependent on the performance of a single sector or region. Now let's illustrate with an example. Consider a portfolio with 3 ETFs. One tracking the S&P 500 for broad exposure to large-cap US stocks, another following the MSCI EAFE index for international developed markets, and a third tracking the Bloomberg Barclays US Aggregate Bond Index for exposure to the US bond market. This mix provides diversification across asset classes and geographical regions. Remember, the key is to choose ETFs that align with your investment objectives, risk tolerance, and time horizon. A diversified portfolio using ETFs can help you weather financial storms and achieve your investment goals. How do you ensure your portfolio remains optimized over time? This question is of paramount importance for any investor who wants to maintain a well-balanced and profitable portfolio. Let's delve into the concept of portfolio optimization. This technique involves the strategic management of your investment portfolio to achieve the best possible risk-return trade-off. It's all about striking the right balance between risk and return, and adjusting your asset allocation to meet your investment goals and risk tolerance. One popular portfolio optimization technique is rebalancing. This involves periodically buying or selling assets in your portfolio to maintain your originally planned asset allocation. Let's say your portfolio begins to tilt heavily towards equities due to market gains. You may decide to sell some stocks and buy more bonds to bring your portfolio back into balance. But it's not just about maintaining balance. Portfolio optimization also involves adjusting allocations based on market conditions. For instance, if you anticipate a bullish market, you might increase your allocation to equities. Conversely, in a bearish market, you might want to shift more towards bonds or other less risky assets. Remember, portfolio optimization is not a one-time event. It's a dynamic process that should be reviewed and adjusted regularly to ensure it aligns with your evolving financial goals, risk tolerance, and market conditions. Regular portfolio optimization is key to staying on track with your investment goals. So, keep a close eye on your portfolio, adapt to market changes, and stay focused on your long-term investment objectives. So, what should you remember about ETF indexes and portfolio construction? Well, first off, ETF indexes are a powerful tool for investors, offering broad market exposure, flexibility, and cost efficiency. They can serve as the building blocks of a well-diversified portfolio, helping to spread risk and potentially enhance returns. But remember, constructing a diversified portfolio isn't just about picking a bunch of ETFs at random. It requires careful planning and a clear understanding of your investment goals and risk tolerance. Moreover, portfolio optimization isn't a one-and-done deal. Regular rebalancing is crucial to ensure that your portfolio's asset allocation remains aligned with your investment strategy. However, as we've emphasized throughout this video, it's always wise to conduct further research and seek professional advice before making any investment decisions. Invest wisely, and remember, every great investment portfolio starts with a solid understanding of ETFs. Do not forget to comment, like, and subscribe for more insightful content.